Hello, everybody, and welcome to our class. Today, we're going to talk about writing a short call strategy. We're going to learn what is this strategy is all about. What is this thing called writing options, and some may refer it as selling options, selling call options. We're going to talk about selling call strategy and see how we can benefit from it and what things we should be avoid of and how generally this strategy works. So let's see. First thing, what is a short call? Well, the official explanation for this is a short call is an option trading strategy in which the trader is betting that the price of the asset on which they are placing the option is going to drop. Calls give the holder the option the right to buy an underlying security as at a specified price. If the price of the underlying security falls, a short call strategy profits. If the price rises, there is unlimited exposure during the length of the time the option is viable, which is known as a naked short call. Other words, we are going to be now at the other side of the trading platform, and we're going to sell something to someone who's going to buy it. So we're talking, remember this guy at our previous lesson when we studied about buying call option? And now we're going to look and see and understand the other side of the sellers who sell this obligation. Remember that writing an option is a new creation of obligation in the market that makes a new interest position in which the seller is obliged to sell the underlying at a given price at any time. That means that we are selling an obligation to physically deliver the underlying, which could be stock or ETF, to the buyers, who bought this call option. So this is much more serious case now because we are here now talking about obligations, and this could be serious stuff, and we're going to explain it pretty shortly. Now, take in mind that any naked writing of an option demands securities in the form of margin calls. That means that whenever you're putting a new position in the market and you're selling any option, you're also obliged to give some securities in the form of margin calls. That means that the bank or your broker is going to take some certain amount of money out of your account and put it as a security for you and for them, that you will be able to deliver the underlying according to the options scheme. Now, the cash premium is given straight to the seller, and he cannot make any more profit from the trade. That means that whatever amount of money that you were given when you wrote down this option, that's it. You won't be able to get any more money. You won't be able to make any more profit out of this. So think in mind. Um, Another good thing that can happen to you is the time effect. The theta value is always on the seller side as part of his risk violations. If you remember that we talked in our previous lesson, that every option has also a time value, which the buyer pays for it, and he's not benefiting it. Who does benefit from it is the seller of the option. And if the underlying stays pretty much in place, every day the option is going to lose some value out of her price, and the seller is the one who's benefiting from it, right? So now really, really be serious and take in mind that your loss potential is endless. If the underlying skyrockets goes up pretty significantly, you're gonna make a whole lot of loss. And this is very dangerous strategy. If you're doing it naked, you should be aware of the consequences that you could lose a lot of money. And I'm talking from experience. All right, so the seller of this option is taking the downside, shortening the market. Of course, this is the most thing that you want most in your life now is that the underlying is going to crash. It's going to fly down. It's going to burn. It's going to go down. No way it's going to go up. You have to be certain and 100% and take the chances that the underlying is going to go down. But good news, last good news for you, sellers. This short position can always be closed in any trading time. That means that you can close this position even after a minute, after you wrote it, or even after an hour, month, depending on how much time is left on this option to exercise. All right, so let's give an example. Let's say there is a stock which is priced now around $100. Call 100 costs $2. The multiplier is 1, just for this example. And we have 30 days till expiration. And let's say there is no additional commission fees. So let's see our cash flow and how can we benefit and how are we going to benefit from it. So here I built a short scheme for you. You can see the short core cash flow. And we're going to take two scenarios. First scenario, that the market's going to go down. And the other scenario is going to stay pretty much in place. And the other one, the underlying went up. And this is something we don't want. So let's start with a better, with our better scenario. And let's say like after a month, the stock price went down from 100 back to 80, lost 20% of his value. And it went all well for you because remember you got $2 revenue income. An expiration day, this option is worthless. That means zero. No one will exercise something you can buy in the market for 80 and pay for it at 100. It makes no sense. So that means you want a jackpot. $2, that's your cash flow. It also goes the same way if the expiration was at the mark of 90. That means that you still got your $2 revenue income. No one's going to exercise 90. Someone will exercise 90, but it won't exercise 100. So it makes no sense for him to losing $10. So you still got your $2. What happens if the market didn't move at all, ended at 100? Then you still got your $2 income. You won't exercise it for 100, and you got your $2. What happens is 102. This is an interesting point now. At 102, you earned nothing. That means the expiration, you see the cash flow here, 100 minus 102, which was the new expiration point, and you lost $2, but you got $2 from the writing, and the premium that you've got equals to nothing, zero. That means that's 102 is going to be your break-even point in this strategy. But from this moment on, if the underlying continues to rise, you're going to suffer significant loss. Let's say if expiration was at 120, then you still got your $2, but in expiration value, this option, when worth $20, you got back just $2 from it, and you lost $18. Now, I don't even want to think about if the expiration went up to 200, and these scenarios happened in the past before. And at 200, you probably would have lost $98. So watch out. This is an extremely dangerous strategy. And you should keep in mind that this strategy alone is very dangerous, but it can be helpful if you're holding the underlying itself at your portfolio, or you're trying to trade the covered call strategies. And we're going to talk about these in later classes. But for now, let's keep in mind that the option price is made from three major elements. First element is the number of days till the expiration. The longer time there is for this option to live, that means that the price of the option is going to be greater. And that means that you can get more money and maybe less risk when you're selling it for longer terms of expiration. Second of all, intrinsic value plus time value, that's what makes the option price. So keep in mind that if you're selling an option, there is always an intrinsic value plus the time value. And the third one, the most significant, the most important that really truly changes the prices of options is the IV, the implied volatility of the underlying. Makes a tremendous effect also on the implied volatility of the options themselves. And if the underlying is volatile, the stock is volatile, goes up, goes down all the time, then it affects surely the price of options. Okay, so let's see now some examples from real trading. And I want to show you, let's start with a with with a stock which has not such a big underline, which has Dominion. Let's see, Toronto DominionBank.com. This is a stock which has pretty low implied volatility in itself. You can see here, the implied volatility is around 20%, 21%, considered pretty low in historical values. And let's say we're looking at a 28 days expiration. And let's see how much they sell. You can see now that the stock is traded around $73, 72, 72.8. So well, let's see. The implied volatility of the underlying is around, as you can see, 18% for this series of options for 28 days. The call, this is the side of the calls, this is the side of the puts, remember? So let's say call 72.5 is sold right now at $1.80, $1.70. Something between here and between here, let's say $1.80. That's all. That's all the premium you're going to get if you're going to sell this 72.5 call option. So let's see how it works on a graph. So let's simulate that we have sold a single option. Remember that the underlying is traded now at around 73, right? Let's settle it for 73 almost, and you see that we were given $1.70. That's all. We got basically $170. Remember, every option that is traded here has been multiplied by 100, so we got total of $170 to our bank account. So what it does on this graph, you can see that we have this break-even point here at 74.2. That means that if the underlying we're going to rise, if this stock is going to rise above 74.2, we're going to start losing. We're going to start losing money. And from each dollar that the underlying asset is going to rise, we're going to lose $100. So you see, we got a very pretty small premium, and that's why we're pretty tight here. But on the other hand, remember that the stock has an overall very low implied volatility itself. Now let's see another example, pretty much the same. We have here a stock which is traded at $77. It's called Lemonade, and this stock is much more volatile. As you can see, we're also looking at 28 till expiration for this option, but the implied volatility of this asset is 65.4. And that means that if we're going to sell call option on the strike at 75, we're going to get around $7. $7. It's not 180, 170. This is $7. That means that if we're going to sell, excuse me, if we're going to sell the single option, it's been traded at 77. We're selling the call 75. We got, let's say, exactly $7. Okay, so we're going to be protected until 82. In our previous example I gave you, it just gave on the TD Bank, we got only $1.8. Then gave us a space from losing or until losing of just $1.80 for the underlying to move. In this example, because this is a much greater volatile stock, then you can see that we got $7 for 30 days, and the stock is pretty much at the same price, 70 something dollars, but implied volatility on this stock is greater. So now you can see that we got $7 and we are protected. We're going to make money in 30 days from now if the underlying won't rise above $82. So this is better if we're selling. By the other hand, you have to look also at the underlying. And the underlying, as you can see, this stock previously visited the heights of nearly $200, and then it crashed down all the way to 80, and then went up to 100 again, went back to as low as 55, and now it's been only rising backwards. So what you can see here, all those fluctuations that made the implied volatility in the stock and in the options greater and higher. And that's why the sellers are asking for a bigger premium, because they're saying, listen, now the stock is at 77, but I remember that it was also 170. And on the other hand, the put sellers are saying, listen, I remember this stock also went below 50. So we're not going to take chances. So we're asking for a greater premium. And the market and also the buyers agree with that, because they're saying, oh, look, if there were such significant losses recently, then maybe this is time for us to buy the asset and earn when the stock is going to skyrocket again, because now it's a good buying point technically, and that makes sense. But on the other hand, the put buyers also say, now it's going down all the time, so maybe now it's the time to buy put options. And you can see the put options out of the money have even greater implied volatility inside them. So this is an example on two of those. And this is a 65% implied volatility. Now, on the other hand, if you're going to look on the twister stock, and that would be the third and the last example. The stock costs a little bit more, 97.7, but it has a greater implied volatility inside there. Also, you can see this is a 20 days expiration series, and this one has already 83.3, 84, 86% implied volatility inside them. So that means that for this kind of volatility, the sellers are asking for a greater premium. And this one is sold for $10, $11, $12 premium. So this is even greater than the other two that we saw before. Let's see just how it behaves when we're just gonna sell Twister for let's say $11. Then you can see that you're gonna get $11 from this point on, from 95 plus 11 makes it 106. You see, you're gonna get 11 points until you're gonna start losing money. That's significantly higher premium. Remember that if the stock goes down, then voila, you won $1,100, and it doesn't matter how far and deep it's gonna drop down. But if it rises up, you're still gonna lose just $100 for every $1 that the stock has risen. Okay, so that's it pretty much. This is a strategy that I strongly advise you not to do. But if you're taking your chances, then good luck. It could be extremely dangerous. Stocks can skyrocket and also fall down and crash. And I don't advise you do it without any protection or what we call hedging. And in our next lesson, we're going to see how this strategy can be helpful for us. But just for the example for today, I wanted to show you this strategy and try to avoid it if you don't want to lose a lot of money. It might work several times, but once the market is what is called running away from you, you're going to lose a significant amount of money. So hope you enjoyed this class today. Hope to see you next time. And good luck for everyone. Goodbye.